We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Inflation on the rise, the market's going crazy, and the Fed looking at another interest rate hike. Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and with me today for our Wallet Watch segment is Chris Calandri from Elliott Wealth Management. Chris, how are you today?
I am very good. As usual, when we get together, there is so much going on. Yesterday was a key day. The markets, as you know, and your listeners probably know, got pummeled. And it's due to some inflation numbers that came out worse than expected. So there's a lot going on. I'm glad we're going to cover at least some of it today.
Yes, we had the CPI numbers, consumer price index, come out yesterday. We had the producer price index come out this morning. Both numbers still show inflation near historic highs.
Yes, and I think what I've been talking to my clients in my practice about, Eric, is the wall of worry that the market can mount recovery oftentimes, even in the face of bad news. One of the reasons is people get accustomed to new normals. And the second part of that is if you could get some less than expected bad news. Americans are optimistic, forward-looking people, generally speaking, so that if you could get some numbers that are a little bit better than expected, not good news, but not as lousy as expected, you can make some progress. Well, what we found yesterday was the expectations were not negative enough because the CPI number was expected to come in at 8.1. It actually came in at 8.3% inflation, which in and of itself, Eric, is bad. That 8.3%, 8.1%, that's high, that's bad. That's 40 years. Got to go back 40 years to find a comparable period. But going from 8.1 to 8.3 statistically is not significant, but it shows that it's still increasing, that we haven't even turned over the trend line. And that is worrisome. And it's not what people expect, which really, really spooked seemingly everyone yesterday.
It really did. And to put this in some context that people can really appreciate, the inflation numbers that have come out, if you put this over the course of what's been going on in 2022, it has cost the average family an additional $4,000 in expenses. Now, wages have been going up, but not nearly as fast as the inflation is. People are having problems coming up with that additional $4,000.
Yes, especially younger, poorer, disadvantaged communities are feeling this in a very significant way. And to your point, Eric, it's not like the cost of high-end computers are going up 10% at a clip. That would be bad. But food is going up so strongly ahead of the mainline inflation numbers. I think food in yesterday's run was 13.5%, I believe. So, if you're at a tough time making ends meet and sort of are paycheck to paycheck kind of family, food going up, 9, 10, 13% really has a negative impact on your budget. And given yesterday's worse than expected numbers, it's hard to see where the relief comes from especially for those families and communities.
Yeah, it's been really tough. And those inflation numbers are starting to affect businesses as well. A number of companies have already announced, and some have actually gone ahead and done layoffs because they now need to cut their expenses in order to not pass these huge cost increases on to the customer.
Yes, you're seeing more of that. Although, given everything that's going on, one of the wild aspects of all of this is how incredibly strong the job market is and has been. Touching on the political side of this, the administration has leaned into the good news about the strong job market, and it is strong. There are reasons for it, such as people just going back to work, not exactly job creation in the classic sense. But they've touted the strong job market, and your listeners, you and I, see this every day. Seemingly, lots and lots of businesses are hiring for lots and lots of positions. But if, to your point, Eric, you see unemployment numbers worsening and the job market weakening, not necessarily getting really bad, even just weakening, boy, that would really unsettle things, including on the political front, because the Biden administration already is having a difficult time. If that was added to the mix, whoa, his administration would be in a very difficult position. Not that they're doing great as it is.
Yes, and speaking of the political front, we also saw yesterday, in addition to these numbers, the tone deaf uh, condition of the administration. As after these huge inflation numbers came out, they had a celebration on the lawn of the White House to celebrate the signing of the Inflation Reduction Act, which the nonpartisan Congressional Budget Office has already said will do nothing to curb inflation, especially in the short run. And now that the administration is pushing these student loan forgiveness plans, they've actually eliminated all of the deficit reduction benefits of this act.
Yes. Yeah, wow. How could I say this? I'm gonna be professional in talking about this and not be terribly emotional. And I want to talk more as a professional and less about a citizen. But you're right, it was bizarro world. First off, it's just incredibly weird that they did this, planned this on a day then the CPI numbers were going to come out. And he seems very out of touch because he's touting this accomplishment on a day when you get pretty bad inflation number, really a sign that we're still very, very much in the fight trying to get inflation wrested under control. But if you listen to the president speak, and you didn't watch the other news from yesterday, including the downturn in the market, you would feel like, hey, we're making some progress and we got this thing on the run. And it's hard to square his public commentary yesterday with the news we got in the exact same day. Seems to me the administration is focused on advancing their agenda, which includes trying to get a good outcome in the midterm elections for the Democrat Party. They are not really interested in bringing down inflation. That's my opinion. And you pointed out this legislation that he touted. You could really not find many folks out there, professional economists and policy watchers, that point to this doing anything for inflation. You mentioned the nonpartisan group point to University of Pennsylvania. UPenn said it'll decrease the inflation by 0.1%, and that's inconsequential. But it's got kind of a nice marketing name, but it's just flash. It's not real. And I did want to touch upon this because I think it's critically important. The Federal Reserve is raising interest rates, which also is going to hurt those same people you and I talked about earlier. the expectation is the Federal Reserve is going to raise interest rates another 0.75% next week at their next meeting. After yesterday's activity, the odds are in favor of it actually being a 1% interest rate. And what the Federal Reserve is trying to do is deal with inflation by raising interest rates, which is meant to slow economic growth, dry up some of the money supply that's out there. That's how they're trying to deal with inflation. But the Biden administration is at cross purposes with the Fed. They are not working in tandem. I know, you know, the Federal Reserve is independent, but you would want, in a situation like this, which is pretty severe, for the two powerful entities, the executive branch and the Federal Reserve, to at least be pulling in the same direction. And they are not. The Biden administration wants to put more stimulus, more money in play to carry out their agenda. They believe it's in their best interest, maybe the country's interest. I disagree with it being in the country's interest. But they're putting more money in, which is counteracting what the Federal Reserve is attempting to do. That's a big problem, Eric.
It is a big problem. You know, you're dealing with historically high inflation, especially according to yesterday's report, food prices, which affects everybody. It's actually the one factor in there that nobody can escape the effect of. We saw the markets crash yesterday. Pundits are saying, well, it's because they're expecting now the 1 point increase in interest from the Fed next week. I've also heard a number of people say part of the reason was because they expect the bond market is now going to react to the interest rates and the inflation rates as well. Can you comment on that?
Yes, we are, in addition to all the other weirdness, because everything we talk about is unusual. And that stems from this really still being the aftermath of the pandemic. But generally speaking, you know, bonds do well in an environment where stocks struggle. That's just a classic understanding. And that's not happening. The bond market's having a very difficult time because we're dealing with these rising interest rates, and bonds tend to struggle in a period when you have inflation and rising interest rates. So you have both bonds and stocks struggling mightily this year. It's fairly unusual for them to be trading so negatively together. And it's a problem for investors because in a typical what's called balanced portfolio, Eric, which a lot of investors use, professionals use, which classically is you have about 60% in stocks, 40% in bonds. It has very good long-term returns. And what you're trying to get is that balance so that when the stocks are doing well, you participate. And when they struggle, the bonds can and usually do pick up some of the slack, taking some of the edge off of the risk. And bonds are a nice, safer component in that balanced portfolio. Well, balanced portfolios today have gotten creamed this year. They've gotten creamed this year, the likes of which we've never really seen, briefly during the Great Recession, but it didn't last very long before returning to a little normalcy. You look yesterday, Eric, there's really very little place to hide other than cash. You know, gold went down, commodities went down, cryptocurrencies went down, bonds went down, stocks went down, big ones, small ones, value, growth, ones with good news, ones with bad news. There's not much that's working now. So it's a really challenging environment for investors and for me in my practice, because you have to deliver bad news to clients, but there's not a lot of great options in terms of putting money someplace that is working in the short term. Now, long term, I mean, you probably stick with your plan. If you have a good plan, it's going to work over time. But in the short term, you might have to continue to hold your nose and walk through some crap.
Yeah, I think that's the best way to put it. We are in interesting times. Thanks for being here for Wallet Watch, Chris. to summarize, stocks are down, bonds are down, commodities are down, interest rates are up, inflation's up. The economy is in an interesting place, and that's the raw naked truth. You can catch the raw naked truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.